So, on May 6, 2010, for just a few minutes, the entire global financial system, it just broke. I mean, the gears seized up, prices became completely meaningless, and trillions of dollars were hanging in the balance. This is the story of the flash crash.
So the big question is, how could this possibly happen? In what's supposed to be the most advanced financial system in the world, how does almost $1 trillion in value just vanish and then reappear in the time it takes to grab a coffee? To really get a sense of the scale here, just look at this number. That afternoon, the Dow Jones Industrial Average had its single biggest intraday point drop in its entire history. We're talking about a fall of almost 1,000 points. That's a staggering 9.2% dip in minutes. This wasn't some slow motion crash. It was a straight up vertical drop.
Okay, so an event this crazy doesn't just happen out of nowhere, right? To really get what happened, we first have to understand the environment. The market was already incredibly fragile, kind of like a building that already has cracks in the foundation, just waiting for a tremor. And that tremor, well, it came in the form of just this massive global anxiety. The huge story that day was the Greek debt crisis, and that fear was spreading all over Europe. This created what we call a risk-off mood. Basically, investors were scared. By 2:30 p.m., the VIX index, which is often called the market's fear gauge, had already rocketed up by over 22%. People were scrambling for safety. But underneath all that, something way more dangerous was going on. The market's shock absorbers, the pool of buyers who are willing to step in and buy when things dip, they were just disappearing. In the most important futures market, the number of buyers had been slashed by more than half. The safety net was being taken away piece by piece. And this gets us to this absolutely crucial concept, liquidity. The easiest way to think about it is like the depth of water in a swimming pool. When the water is really deep, that's high liquidity. A big splash doesn't really cause much of a ripple. But in shallow water, low liquidity, even a tiny splash can hit the bottom and send waves flying everywhere. Well, on May 6th, that pool was dangerously shallow. So into this very shallow pool, a massive seller was about to drop a cannonball. And this seller, it wasn't even a person. It was a computer program. Yep, at 2:32 p.m., one single firm started a sell program worth about $4.1 billion. And to get this huge trade done, they didn't call up a human trader. Nope. They handed the keys over to an automated algorithm that was built to sell 75,000 futures contracts as fast as it possibly could. Now, the algorithm's logic was actually pretty simple. It was told to sell a chunk that was equal to 9% of whatever the trading volume was in the last minute. But here's the thing. It had a massive, critical flaw. It was completely price blind. It had one job, sell, and it did not care one bit if the price was $100 or $1. And the result of that logic? Just breathtaking speed. The entire $4.1 billion order was dumped on the market in just 20 minutes. Now, to put that into perspective for you, the same firm had done a similarly sized trade before, and it took them over 5 hours to do it. This thing was pure, relentless, automated aggression. So what do you get when you have a super fragile market and a massive price-blind seller? Well, you get a devastating feedback loop, and it was fueled by a whole other group of automated traders. At first, it actually seemed like the system was working. High-frequency traders, or HFTs, are basically computers designed to buy and sell in fractions of a second. They jumped in and started buying what the big algorithm was selling, so they were acting like this temporary buffer. But the key thing to know about HFTs is they do not like to hold on to risk for very long. And yeah, just a few minutes later, they hit their breaking point. Between 241 and 244, the HFTs did a complete 180. They flipped from being buyers to being massive sellers because they were desperately trying to get rid of the contracts they had just bought. Suddenly, the selling pressure on the market had basically doubled. And this is what created something investigators later called the hot potato effect. You had these HFTs just trading contracts back and forth among themselves at lightning speed. Now, this created a ton of trading volume, but it was just an illusion of liquidity. And what did our big price-blind sellers algorithm see? It saw all that volume, and just like it was programmed to, it sped up, dumping even more contracts onto the fire. It was a perfect destructive loop. The final moments were absolutely terrifying. In just the 14 seconds between 2:45:13 and 2:45:27, 27,000 contracts were traded.
A second later, the pool of buyers was just gone. Less than 1% of its morning level was left. Then, at 2:45 and 28 seconds, the market hit a wall. A single, automated 5-second pause was triggered. And that pause, it changed everything.
So while that 5-second pause was about to stop the bleeding in the futures market, the chaos was just getting started everywhere else. See, what happened next wasn't just one crisis. It was two, happening at the exact same time. First, you had the index crisis. This was driven by that algorithm and the HFTs, and it caused these huge index products like ETFs to just plummet. But at the same time, you had the single stock crisis. As all the automated systems were going haywire, the human traders, understandably, pulled back, which created a total lack of buyers in thousands of individual stocks. And this is where things just get completely absurd. Take Accenture, right? A huge global consulting firm. In the middle of all this chaos, its stock, which had been trading at over $40 a share, suddenly traded for a single penny. The whole price discovery function of the market had utterly failed. So how is that even possible? The answer is something called stub quotes. These are basically just placeholder bids, often for a penny or even less, that firms have to post to meet regulations. They are never, ever meant to actually be hit. But with all the real buyers gone, this flood of automated sell orders just cascaded down, hitting anything and everything in their path, including these penny bids. The scale of this single stock chaos was just immense. When the dust settled, the exchanges had to cancel over 20,000 trades that happened at prices that were more than 60% away from their real value. For a few minutes, the stock market was basically a fantasy land of impossible prices. So what did we actually learn from this near-death experience for the financial markets? The flash crash was a brutal, high-speed lesson in how our modern automated financial world is actually put together. The big lessons were pretty clear. First off, high trading volume can be a total illusion. It's not the same thing as a deep, stable market. Second, price-blind algorithms are basically a loaded gun in a volatile environment. We also saw that the liquidity provided by computers can vanish in an instant. But on the bright side, we also learned that a simple, brief circuit breaker can be incredibly powerful. And finally, that our markets are so tightly connected that a problem in one little corner can become everyone's problem in a heartbeat. And that really brings us to the final question. The flash crash led to new rules, new safeguards like single stock circuit breakers. But today, the markets are exponentially faster and more complex than they were back in 2010. So the question we're left with is a pretty critical one. Are the rules that were written for the last crisis really strong enough to prevent the next one?